Hi, I'm Chad Bordeaux, and welcome to another video edition of the Bean Counter Ramblings blog. Today I'd like to talk to you about North Carolina Senate Bill number 1015, also known as the Homeowner and Homebuyer Protection Act. Basically what this bill does is it's supposed to help protect homeowners and home buyers, but I believe it has several provisions of the act have a very negative effect on real estate investors, individuals that are hoping to purchase a home but may not otherwise qualify. Maybe they've had some credit issues in the past. And it also has a negative effect on individuals that may be behind on their mortgage and are facing foreclosure. It really limits their options on being able to protect themselves from foreclosure and basically rescue themselves from foreclosure. While the full details of the act, I've put a link to it on our website underneath this video so that you can go read it for yourselves if you want to. I wanted to highlight three provisions in the act that I think are most damaging or really negative and really should be changed or edited so that we can take the proper action now to try to keep these three things from becoming law, or to get them changed at least in such a way so that they make more sense. First of all, investors are not going to be able to buy pre-foreclosure property. They're not going to be able to go in and rescue homeowners in a situation where they pay less than 82% of the fair market value of the property and then allow the homeowner to retain any interest in that property. In other words, they're not going to be able to do a lease to own back to the homeowner, a buyback. They're not going to be able to let the homeowner retain interest in any way. Right now, as it stands, a homeowner may be facing foreclosure. An investor can come in, buy that property out of foreclosure, and then work out an arrangement with the homeowner so that they can do a lease to own or something so that they can get back on their feet and then potentially not lose their house. This provision of the bill is going to basically eliminate that rescue opportunity, and many homeowners will lose their home because of this. The second provision that I think that needs to be addressed is that investors will not be able to sell residential land or property using a contract for deed or other seller financing unless they do not have a mortgage on the property. Right now, seller can go out, or somebody can go out, and if they can have a mortgage on the property, they can, if they're unable to sell that property, they can still seller finance the property and use the money that they're getting in payments to pay their mortgage. The risk is really on the seller because they've still got to pay their mortgage regardless of whether they collect payments from the buyer that they've sold it to. I guess I said seller, but it's really the person in the middle of the transaction is really who is assuming the risk, because they've got to have the buyer pay them the payment so they can make their mortgage payment. Either way, they have to make their mortgage payment. With this new law, that's not going to be something that's allowed. Unless you can pay off your entire mortgage, you cannot sell your property to somebody else. The downside of this is, or the big boom for the banks is, they've basically eliminated 99% of all seller financing. It's just not going to happen because no real estate investor is going to give up their leverage to that degree. The other thing that this kind of does is it prevents a developer or an investor from coming in and buying, say, a subdivision of 30 acres or 40 acres or a plot of land that they're going to put a subdivision on, divided it into the subdivision, and then at that point they're not able to sell any of those lots through seller financing or through any kind of lease option or anything of that nature without paying off the mortgage on that original 30 acres first. It's just not going to happen. Just not enough. Most developers and investors just do not have the capital to do that. They operate through leverage. The third provision, which I found really just mostly odd than anything else, is that if you sell a property through a contract for deed or through some sort of seller financing, any down payment that you receive on that property, you have to hold in escrow for the entire life of that loan. So if you sell a property on, you do seller financing on a contract for deed for 30 years, and somebody gives you a $25,000 down payment on a $200,000 piece of property, you've got to hold that $25,000 in escrow for the entire length of the contract, which to me makes no sense. I can understand them making you put that $25,000 in escrow until the proper paperwork was filed to record the liens and all that stuff at closing. But once that has occurred, it makes no sense that you can't get your money from your down payment. It's actually your money. Anyway, those are the three provisions that I think that need to be addressed strongly. I encourage you to look at the law in detail and to do what you can, if you're in North Carolina, to contact your representative. If he or she is on the committee that's going to vote on this, would be great. If they're not on the committee that really I wouldn't say votes on this, that forms this law to get it to the floor for vote, if they're not on that committee, they may be able to have some influence over the person that is on that committee. They may be able to talk to them and explain to them the way their constituents feel. So contact your representative. It's best to send a letter. From what I hear, that try not to mail it, try to send it either fax or email. But contact them, let them know your concerns, and I look forward to talking to you again on the next video edition of Bean Counter Ramblings blog.